Well, it's good to have a catch up as we do from time to time. This time with Mark Perchtold, who's the founding director of OMBA Advisory and Investments. Mark, we couldn't have timed this interview better. Yesterday, gangbusters in the United States. My favorite share, Cloudflare, 25% higher. I don't know when last I was invested in anything that went up 25%, although it went down 18% when the financial results came out. So, volatility, the name of the game. Let's just perhaps pick up on immediately on that huge gain that we saw on the US markets on Thursday in the wake of inflation figures. The NASDAQ showing one of its 5 best performances in 20 years. And this is very out of the ordinary. Explain to us what the heck is going on.
Morning, Alec. I mean, yeah, exactly. Volatility is certainly the name of the game in this current period. I mean, we can expect more, to be honest. I don't think it's the end of up and down days of extreme nature over the next sort of 6 to 9 months as you get economic data and inflation data. Obviously, the inflation print coming in lower than expected was a very big boost for markets because everyone wants the Federal Reserve to become a little bit more dovish and perhaps hit peak rates sooner, or maybe not hike as much over the incremental hikes that are coming. So, in financial markets, they say when the US catches a cold, when the US sneezes, everyone else catches a cold, as you may have heard. And the US is still a major driver of how broader markets globally will perform. And inflation data running hot in the US, causing the Fed to hike rates, and obviously the whole bond curve shifting upwards, has been a massive knock on markets this year, both equity and fixed income. And I think, earnings season is still not complete, but, we're quite a long way through it. And a lot of companies have actually been beating their guided earnings, but many of them have guided down on a poor outlook. And so, you've had a really big sell-off on many days of the market, and you've had big bifurcation across various equities in the market. So you'll see some stocks rally strongly post earnings announcements, others fall brutally. And I think that's just because investors are so unsure of the outlook. And it's very hard both for directors of companies and CEOs to gauge how things look. But in general, if financial conditions are easing, which is and one of the big inputs to that is obviously interest rates, people are quite optimistic that growth will continue. So I think, very much driven by the moves down in interest rates yesterday in terms of the curve shifting downwards, which obviously was a boost for stocks. I think it was perhaps a little bit overdone. I think we can expect some down days in days to come because the bounce was very strong.
So, where are we in the cycle now, given that share prices this year have had one of their worst years ever? And from your perspective, investors must be scratching their heads and saying, well, is this the bottom? Should I be giving Mark and the OMBA guys more money to invest so that I can have a good ride up? Or are you still cautious?
I think the market's always very forward looking. So, stock prices reflect the estimation of the future. And I don't think from an economic perspective we're out of the woods. I think you could still see negative GDP prints from many developed countries around the world over the course of the next sort of 6 to 12 months. But the market's been anticipating that. So that's not necessarily new information. Tightening monetary conditions, slow down globally, it will cause equity prices to fall, but that's already been priced in for a large part of this year. So I think from an economic point of view, I don't think we're out of the woods. I think, households across many countries, certainly UK, US, Europe, in many other countries where interest rates have risen are going to feel the pinch. You've got the double whammy of higher prices on the one hand, particularly for things like energy, coupled with higher interest rates. So if you've got a mortgage, or you've got a mortgage which is in the UK, for example, if a fixed mortgage which is flicking into floating over the next sort of 24 months, you're quite worried, and so you might tighten your belt and therefore spend less. In the US, I think there's less of a worry on the consumer side because of mortgage rates. The long end has gone up to close to 7%, 6.8% on the 30-year mortgage. And the good thing versus the GFC is that most mortgages in the US now are fixed for the long term. So it won't hurt the consumer as much. But despite that, you've got high energy prices. So I think the economic data is still likely to be weak over 6 to 12 months. So we can expect bad headlines as GDP data prints, as PMIs print, and I think inflation remains elevated, but it is somewhat peaking and coming down as we've seen by the print yesterday. And I've argued, as you know, for a long time that I think inflation over the sort of medium term will definitely decline because you've had demand destruction, you've got the issues from supply chain bottlenecks abating, you've got supply coming online in commodities. So our view is that inflation continues to come down, therefore central banks aren't as hawkish, they become more dovish, and the market then reflects a better outlook. But the actual pain in the economy, I think, will be felt over certainly the next 6 to 12 months. But that doesn't mean stock prices will continue to fall. I think we're forming a base. Calling the bottom, as I said last time we spoke, is impossible. And so our view is one should begin accumulating equity whenever you have drawdowns north of 20%. It may be a 40% drawdown, but it may not. Drawdowns aren't always that deep. And we've already had meaningful drawdowns. The Nasdaq's down over 30%. That's a meaningful number. Certain stocks, blue chip, well-known companies are down over 50%. They've halved in value. So that's an opportunity to pick up good businesses that generate cash flow, that are profitable at a discount. So our view is that on the equity market side, it's a time to begin accumulating with the view that there could be a lower level. It's impossible to gauge because you're going to get bad headlines over the next 6 to 12 months. But economically, we're not out of the woods at all. So I think it's hard to gauge exactly where we are in the cycle. I think until you see interest rates and base rates coming down from central banks, until you see those declining, we're not going to see a big boost in economic activity.
So if you're the kind of investor who wants to sleep at night, what, what do you do when I approach you and I say, okay, Mark, I know you guys you are South African, but you're actually based in the UK. You're based in London, the middle of the financial world. You look around the world, you're looking for opportunities all the time. You use that, you reduce the risk through buying exchange traded funds, low cost, lower risk. How am I going to be able to sleep at night knowing that you are looking for a conservative, in other words, option in this incredibly volatile market? Because when guys wake up in the morning and they see a stock is down 18%, it's enough to get the heart going a little faster that you don't really want to start your day that way.
Absolutely. I think, going back to sort of fundamental principles of investing, a big part of it is diversification. So we inherently use ETFs, which hold lots of underlying stocks. And so our equity exposures are globally diverse. It's very difficult to call exactly which market will be the outperformer, but that's what we try to do. And there are certain markets which trade at lower multiples and are cheaper in aggregate. And those are ones you would want to accumulate more of once you've had a drawdown. But the reality is that investors need to accept when they move into the equity world that there's going to be volatility. The potential for drawdown is always there. But unfortunately, if you leave your money in the bank, earning bank deposit rates, and inflation's running high, you're guaranteed to go backwards in real terms. If inflation is running higher than your deposit rate, you are guaranteed to lose money in real terms. Now, in equities, you're not guaranteed to lose money. You can certainly lose money if markets fall. But over the long term, equities deliver the best return above inflation. And the reason for that's reasonably simple. If you're a company and you've got higher input costs, from increased labor costs or increased raw materials or increased, energy prices to produce your good or deliver your service, you're going to change the selling price to your customer. So when you have rising input costs and inflation, companies are in business for a profit in general, and therefore they adjust the selling price. So over time, that becomes a natural inflation hedge as prices are rising. So when you're in a high inflationary period, holding cash, although it may make you feel comfortable on a headline paper number, you're guaranteed to go backwards in real terms. So our view is that people should allocate to equity, certainly once you've had meaningful drawdowns, but with the knowledge when you go in that it's certainly possible you fall, but you have to take a certainly north of 3 year, ideally north of 5 year view that equities will deliver better returns than holding cash on deposit. And then as we think about the world, it's trying to find cheaper sectors, cheaper countries, cheaper. We use smart beta or factor ETFs as well, which exhibit certain qualities. So there are ways in which you can express a more nuanced view using ETFs. as you look at the world today. And we were underweight US technology in our portfolios last year because we felt it was just overvalued. That hurt us in 2021 because tech continued to tear upwards. But that was the right call, as we've seen this year. And so now, as tech starts to look more reasonably priced, it was until a couple of weeks ago at sort of fair value in terms of 10-year long-term averages, and now it's slightly below. We think it's a time to begin maybe accumulating large cap US tech with the knowledge that you may not be at the bottom. I think we've had a very interesting decade or two in technology post, the tech bubble and bust. And, the growth that they've had over the last 20 years might not be the same over the next 20 years, but these are companies that generate profits in terms of the large technology businesses.
That's so interesting that because there are many South Africans who today might have invested more into Apple, Amazon, Alphabet, Netflix than they have in JSE listed shares. And we're seeing that the JSE is contracting. And because it's so much easier through easy equities and Standard Bank Web Trader to be able to invest offshore. But there's still, most people are more cautious. They rather want to find a decent exchange traded fund. They want to go with, again, that being able to sleep at night kind of factor that one reverts to all the time, particularly if you're based in South Africa, where you have the rand to worry about as well. What are you saying now to the South African investors? And I know you do have a lot of them on your books. How are you positioning your portfolios or your investments on their behalf to take account of this extreme volatility?
I think it depends on the nature of the investor. What percentage of your assets do you want in your home market? What are your future liabilities in your home market? How much are you going to need to spend in ZAR for children's education, to service your mortgage, to live in SA? And the question then is, how much do you want to take offshore? If you were objective and you landed on the planet today, how much would you allocate to South Africa? And people wouldn't typically answer 50% or 30% or 20% if you looked at the economic and political landscape, perhaps in South Africa versus other countries around the world. You might say, it's ridiculous for me to have half my money in this country. But it depends how much money you've got, and it depends on your future liabilities in rands. So the conversation is dependent on the personal circumstances of each family with whom we work or the investor. When they go offshore, our view has always been that, picking single stocks is great if you are right. But, a lot of active managers who pick single stocks struggle to beat the broad indices. So we use the broad indices as our building block, but we're still thoughtful about country and sector because there are pockets of opportunity from a macro perspective. So diversification is key. I mean, self-directed investors who love to have a stock portfolio, and I was one of these when I was a student. I had my portfolio of 10 or 15 shares. I thought I was really smart. I'd look at the financials. I'd try to pick some shares. Half of my shares happened to be tech companies. We then had the tech bubble and bust, and it was my first lesson. And I sort of lost my shirt in markets in the late 90s, early 2000s, where I thought I was really smart. And then, if you have 10, 15% holding in one name and it goes down 50, 60, 70%, you really feel the pain. When you have a portfolio of thousands of underlying companies globally, you don't have that single stock risk blowing you up. You have broad market beta that can hurt you, sure, in a year like this in particular. But there's no single name that will take you out. And you've obviously seen horror stories over the years, the likes of Lehman, Bear Stearns, a WorldCom, an Enron, a Steinhoff, etc. Our approach is that when you're going offshore, be globally diversified, and then have someone be thoughtful about where you want to maybe over and underweight that global allocation. The big indices, the MSCIs and the FTSE World's indices, they're typically quite Western centric, and they have very little in EM. They're also very US centric and North America centric. And if you look at studies going back sort of 50, 60 years, yes, the US has been the strongest performing market in the last decade. But if you go back several decades, the US has not always been the strongest performing market. Everyone will know about the Japanese market performing very well, the Australian market performing very well. You've had other regions perform exceptionally well, but investors who just simply own the global index aren't necessarily optimizing for the next decade. So if you're taking a 5-10 year view on your offshore savings, which is often the case because it's excess savings and it's often for your children or grandchildren, then one should be global, diversified, and in our view, thoughtful about how you change that weighting over time because things aren't static. Geopolitically, they're not static. Economically, they're not static. Things are changing all the time. And obviously, China is a hotly debated topic. We have a slight overweight to China versus the major indices. We have a slight underweight to the US versus the major indices. And that's a view because we think China's cheap, and the cheapness justifies it. Despite the risks, because it's so cheap, we feel it's justified owning a little bit more of Southeast Asia and China. So that's our approach: diversification at the core. Avoid single stock concentration if you can, and then be thoughtful about which sectors you want to over and underweight. Another example this year, which is relevant, is obviously Germany and the DAX index. It's been beaten up meaningfully because of proximity to what's going on in Russia, Ukraine. And it's fallen more than many other blue chip indices, but it's got global multinational names in that DAX 40 index. And so, from a valuations point of view, it looks very attractive. Now, we know there are risks. Those companies are going to have to cut their energy use, so it might impact their production. That impact of production impacts their ability to sell. So, there's the reason it's sold off is valid. Is it persistent for another 2-3 years? And you're really starting to see supply demand rebalance in energy markets as there's less reliance deliberately on Russia. So for us that's a cheap market. So look at so we've started moving into the DAX in Germany as an example. But someone's got to think about that for you. So that's our approach: is we're thinking about countries and sectors which look cheap. Another very attractive sector in our view from a valuation point of view is automobiles. Automobiles have struggled due to supply chain issues and inability to produce new cars, the worries about energy and the costs and input costs. But it's trading at a 5-6 times multiple. For us, that's an attractive entry point on autos. So there are pockets of opportunity around the world. One that just has to be screening and looking at these all the time.
It sounds a bit to me like what you're doing is arbitraging time, because on a day, on a daily basis, as we saw on Thursday with the inflation figures, you can get massive changes on what has just happened. But if you're taking a 3 to 5 year view, you can see things from a different perspective. So it's almost like you're arbitraging, being a long term investor, on the little changes that are happening today. And as you've explained, knocking the valuations out of kilter when looked beyond today, tomorrow, and perhaps a very short period.
Yeah, exactly. I mean, investors, it depends on the investor, but many investors are typically watching markets daily, weekly, or monthly, and they're looking at their mark to market. We always tell clients of ours, you shouldn't really look within a quarter. Quarterly should be the most frequent period that you look at markets, unless you're a market participant. Some people enjoy markets. They love to follow them. They like to participate. They like to have a punt on a stock. They do it because they want to tell their buddy at a dinner party, I did this and that, and it's fun. It. There's no harm in people doing that. I think it's great if people have an interest in markets, but some people don't care. They just want to get their mark to market. And our view is always, you should look maybe semi-annually or annually if you can. Most people can't. But then on a quarterly frequency, and just think about your positioning, because markets oscillate up and down widely in that intra-quarter period, and it's best to look at the end of the quarter and say how things done and what drove those things. So our view on our tilting of portfolios is we're not day traders or even weekly traders. Our views are typically 6 to 18 month views or longer, where you want to own a particular market for a period of time. An example of one we're looking at now is, following the Brazilian elections, we're closely looking at Brazil. What is the impact of Lula coming in? How are things going to change from a policy point of view, which could be a boost for the Brazilian stock market. So, we'll do a deep dive and spend several weeks looking at Brazil, because we don't want to own Brazil just for 1 or 2 weeks. We want to own Brazil potentially for 1, 2, 3 years, as we think, new president, potentially new policies could be good for Brazil. But it requires a lot of homework and a deep dive on that particular market. So geopolitics, economics, valuations, they're all inputs into our decision making on how we think about where to allocate your money offshore.
And as far as the process of saving is concerned, are you one of the rand cost averaging, or I suppose in your case, dollar cost averaging proponents, where you put a certain amount away every month? Or if you've got a lump sum, do you spread that over a period of time as well?
I think, my general view is that you should have enough, as pertains to South Africans, you should have enough money available to live your life in South Africa comfortably. And everything in excess of that should go offshore and be globally diversified. Depends how much people have, how much excess liquidity. Our view is don't time the rand. over time, the rand will devalue due to traditional economic theories like inflation parity and purchasing price parity. Forget about idiosyncratic South Africa risks. Just good old economic theory will show you that the rand will devalue because it's got higher inflation than many other developed countries. So that's an expectation. Trying to guess when is the optimal time to move rands out is somewhat of a mug's game. There are, of course, opportunities where, if the rand is particularly strong, maybe you do a little bit more that particular year. But on an annual basis, or even more frequently if you can, just externalize your excess liquidity and build a global portfolio. So I somewhat subscribe to sort of dollar cost averaging. Just have a process where you're constantly doing it, and you can be frustrated on the one hand or happy on the other hand. So if you're just doing it consistently, one year you got a great level and the next year you got a poor level. But if you do it over 5, 10, 15 years, over time, you generally come out happy. And you're avoiding that concentration risk to one country and one currency, which is the important thing. We think about concentration risk to one currency and one country all the time. In the UK, sterling's obviously been beaten up. Bond yields have risen meaningfully. We've got about a 7% exposure to the UK market. And we know our exposure, but if the pound went to parity with the dollar, which is not our view, but just say it happened, we know it's going to hurt that 7% exposure, but we haven't bet the house on the UK. We're pragmatic and practical about how much exposure we want to particular currencies.
Mark Perchtold, thanks for the update. He is with OMBA, and I'm Alec Hogg from biznews.com.